I'm confused. When you want to get credit to use, they tell you you need credit. But how are you supposed to get credit if no one will actually give you credit? Does that sound familiar? Well, keep watching because I'm going to share with you everything you need to know about how to really get good credit and to keep it for life. I run into so many people who know very little about their credit. They're even afraid to look at their credit score, and it's understandable. There's so much folklore and misunderstanding about credit, and most of it coming from parents and grandparents. Got to think about it. When most of your parents or let's say grandparents were growing up, credit was not immediately available to most people. They lived in a cash world. And if you didn't have cash, you put it on layaway until you had the cash to get it out, or you didn't buy it until you had the cash if it was hopefully still around. I remember my mother surprised me for my 15th birthday with a yellow 10-speed bike from Sears that she had on layaway for several months. Parents and grandparents' concern over credit is understandable. For most of their lives, they grew up without easy access to credit. And as you'll learn in this video, it's easy is not always better. Our goal with this video is to really dispel the myths surrounding credit and to give you a simple, bulletproof plan to successfully obtain and manage and maintain the type of credit score that unlocks the world you thought was never available to you. Here are 7 questions answered in this video. Number 1, what is credit? Number 2, why do I need it? Number 3, what is a credit score, right? And then number 4, what are the 3 main credit scoring systems? Number 5, what does FICO actually mean? How do you establish credit? It's number 6. And number 7, how do I maintain a good credit history? Okay, so those are what we're going to talk about. So what is credit? Well, by definition, credit is simply the ability to borrow money to purchase goods and services. Credit is a financial instrument, and like any instrument or tool, if used responsibly, can build an empire, or misused, can quickly dismantle an empire. Despite what you've heard, you don't need perfect credit or a perfect credit score to get access to thousands, if not millions of dollars within the financial world. What you need is simply good credit. We'll explain the difference in this video. The distinction is important, so keep watching. Why do I need good credit? Well, because good credit unlocks the next level of life quality for you. This obviously has to be complemented with, the money to pay for the items that you're going to buy, but that should go without saying. But assuming you do have the money, with good credit, you can rent a better apartment than you could with bad credit, buy a better home, gain access to higher paying jobs, get better insurance rates, get a lower rate on credit cards and car loans. Well, you're probably asking, why do I get better rates on these things when I can actually just pay cash for these items, and why does it matter? It's because companies use your credit report to determine if you're a responsible payer. And they determine this by requesting and reviewing your credit score. So that tells them a lot about who you are. So what is a credit score? It's a 3-digit number known as a FICO score that dictates your access to a whole world of financial possibilities. It's used to measure your financial responsibility. That's how well you've managed the credit you've been extended this far, and summarizes to a credit grantor if you're a worthy credit risk. Credit score is one of those things where the credit grantor believes your past behavior is a great indication of your future behavior regarding your credit use and responsibility. And in the case of a FICO score, a higher score is better than a lower score in general. Now, you've heard the term FICO, but what does it actually mean? It stands for Fair Isaac Corporation, the best known of the several companies that provide software for calculating a person's credit score. Fair Isaac Corporation, also known as FICO, was the first company to offer a credit risk model with a score. So, what are the 3 credit scoring systems? Well, there's TransUnion, Equifax, and Experian. So, these systems independently track, record, score, and report your use of credit. So, what is a FICO score range? In general, without getting in the weeds here and splitting hairs, for most consumers, the score for each of these scoring systems will range between 300 to 850. In general, higher is often better than lower. Scores between 725 and 800 are considered really good. But score alone is not the only factor, as you'll see in this video. It's possible that someone with a 725 score gets better terms and a lower rate than someone with an 800 credit score, so it's not all score. One of the things I hear some people talk about is a FICO middle score. Now let me explain this. A FICO middle score, as it's explained by a lot of people, right? It talks about 3 scores. So each of the credit bureaus will give you a score. And what you do is you'll have the high score, a middle score, and a low score. So you kick out the high, kick out the low, and you're left with the middle score. That middle score is your middle score, or some people might even call it a median score. So that's what that is. And it shows you what that middle score is. So in this scenario, your median score would be 713 because you dropped the high and the low. This is very similar to some degree to a VantageScore. Understand your middle score is just an estimate, not a complete picture. It's a bit more complicated than that. Let me see if I can explain without losing you. FICO has versions of its scoring system. The latest version is FICO Score 9, and that was introduced in 2014. Despite the new version release, most lending institutions still use the prior version, which is FICO Score 8, in their decision-making process, because although it's a little bit more sensitive to high credit card utilization, it is also more forgiving of isolated late payments than FICO Score 9. So although the middle score is an estimate, we still think it's a good tool and serves as a pretty decent indicator of the area your credit score is positioned without having the FICO secret formula, which honestly no one has. Now that we've provided a good foundation of understanding of what credit is, why you need it, what a credit score is, what the 3 credit scoring systems are, what FICO is, what it represents, we can now move on to how to establish good credit. But before we do that, let's clear some definitions before we actually start reviewing the 5 components that make up a credit score, so you know their meaning and where they apply. First definition is revolving credit. If it's plastic and swipeable, it's revolving credit. So just think credit cards. Our second definition is installment loans. These are usually auto loans, mortgages, and student loans. Another term is hard inquiry. A hard credit inquiry, sometimes called a hard pull of your credit, happens when a financial institution or credit grantor pulls your credit to make a lending decision. It will actually lower your credit score and can remain on your credit report for up to 2 years. A soft inquiry, however, or soft pull, is usually used for background checks, typically used by employers, insurance companies, banks, landlords, or you yourself requesting your own credit report. So contrary to what most people think, soft inquiries will not lower your credit score, but may or may not show up on your credit report depending on the credit bureau reporting. Here are 5 components that make up your credit score. Number 1, the first component and most important is payment history. It makes up 35% of your credit score makeup. Lenders want to know, do you pay your bills on time? When it comes to credit, your past performance is an indicator of your future behavior. Number 2 is credit utilization, or balance to limit ratio, which is a measure of the percentage of available credit that you have to borrow. It has been recommended by some that you should not exceed more than 30% of your total available credit per credit card or installment loan. This 30% number is not a hard and fast rule, however, but a general guideline that got circulated. There is actually no benchmark credit utilization ratio above 0 that will maximize your credit score, because every credit card is different in their reporting. Some of the highest FICO scores are people with an average credit utilization of less than 6%. What's being measured here is your overall capacity. This is about how much installment debt is outstanding. This is what is reported to the credit bureau, not the balance you're paying interest charges on every month, and what matters for the credit bureau's calculation of your credit utilization. So as an example, you have a credit card that has a $1,000 limit, let's say. You have a $700 balance outstanding. Simply divide the $700 outstanding balance by the $1,000 credit limit, and you arrive at a 70% credit utilization for that credit card. And to get an idea of your total credit utilization, you would add up all your credit balances and all your credit limits and divide the total of your balances by the total of your credit limits. The power of the credit utilization is having access to more of the right credit without having to use it all. As you can see from the first 2 components we've talked about so far, 65% of your credit score is dependent on payment history and credit utilization. Paying your debts on time and not carrying large outstanding balances is critical. If you focus on nothing else that I've talked about so far but these two, you can drastically change your credit score within the next 6 to 12 months. The three remaining components is about fine-tuning your score. But remember, as I said in this section, what is the FICO score range? Score is not everything. Two people can have the exact same score and receive a different interest rate call from the same bank based on how the remaining components are aligned. To put yourself in the best position to optimize your credit score with any lender, you'll need to integrate all 5 components. Let's talk about the other 3 components that impact your score. Number 3, in level of importance, is your length of credit history. This makes up 15% of your total credit score and is based on the length of time of that each account has been open. So you want to think about this. It's pretty critical. It's 15%. And number 4, your credit variety, it makes up 10% of your total credit score. This is a mix of revolving and installment credit, like having credit cards, auto loans, mortgages, and even consistent utility bills. Credit variety is very helpful to your credit score, but has to be done over a longer period of time instead of all at once. Remember, component 1. Number 5, any new credit. This is about recent credit activity and makes up 10% of your credit score. In this scoring component, the credit bureaus are looking at how recently, meaning the last 3 to 6 months, you've applied for new credit, how you've paid on existing accounts, and if you've taken on more debt during that 3 to 6 month period. Now, be extremely careful with this one. It's the skillful combination of all 5 components that will help you unlock larger credit limits on credit cards and loans. Let's talk about how to build credit. There are 3 methods for building your credit. You can use a secured credit card, unsecured credit card, or use an authorized user. You can apply for a secured credit card, which is a great way to initiate or start developing your credit. Now, how it works is you put a refundable deposit in the bank, usually ranging from anywhere from $50 to $500, and the bank issues you a credit card up to $500 or whatever the limit is. And this prevents you from overspending. Credit unions are often a great place to apply for a secured credit card because they don't typically charge fees and there's no overdraft or interest charges since you can only spend what you have deposited. After all, it's your money. I started building my credit initially years ago when I was young using this method, and my wife and I taught each of our kids to do the same. It usually takes about 9 to 12 months to demonstrate responsibility using this method, and it'll show up on your credit report right about that time, right about that 12-month range. The second method is using an unsecured credit card. This is one you'll need to actually obtain some credit to actually get. This is the most common type of credit card. They're called unsecured credit cards because they're not collateral based, meaning it's not attached to any real property like a house or a car that a bank can seize if you fail to pay. So if you don't have established credit, well, the secured credit card is a better option for establishing initial credit. The third way is you can use is what's called an authorized user, and that is you can be authorized on an existing account of another person. And that's an account that's been held in good standing, okay? So this allows you to inherit the great credit profile of that account as if you were actually them. This doesn't mean your parent or relative will give you a credit card and access to their great account. They've worked hard and long for that great account. They're not about to jeopardize that account. So the purpose of this method, however, is that it may make it easier for you to apply for a new personal unsecured credit card account on your own. Actually, watch one of our recent videos about credit cards and which ones are the best that might work out for you. There are some limits to this because banks have gotten a lot smarter about dealing with this loophole. And if you're able to use it, it may make it a little bit easier to establish a better credit profile a lot sooner. You can also expect the credit that you are extended to be relatively small using this method, but it could be a quicker way to get started. I call this the nuclear option. And it's one I've actually never used for my kids. We taught our kids to make money, save money, and then open a secured credit card account and build their own credit using a secured card. And once they've established themselves, apply for an unsecured card and manage it responsibly. I don't co-sign for my kids. We teach them correct financial principles and let them govern their own finances. Nor do I recommend any parent do it if you want them to learn and apply financial responsibility early. If you do want to use the nuclear option, these are some criteria that the credit holder of the account must meet. And they are, the account should be at least 10 years old or more. The account cannot have any late payments, and the credit card is at no more than 10% credit utilization. We talked about credit utilization earlier in this video, so if you need to go back and watch that. If the credit card doesn't fit this criteria, it will pull your credit down further than it was before being added as an authorized user. So be careful with this. It will do more damage to you if it's done the wrong way. Remember, good credit can take some time to develop, but it can be lost in a blink of an eye. So make sure as you get it, protect it. Now that you know what makes up the 5 components of a credit score and you know several ways to begin building credit, let's talk about what it takes to maintain your good credit. One of the things you'll want to do is you'll want to pull your personal credit report at least once per year. When you do this, get the paid credit report. The free ones are okay, but the paid ones are better because you want all 3. It will be one of the best dollars invested for the well-being of your financial future. This allows you to review changes to your credit report and catch any inaccurate reporting that could lower your score and go unnoticed. You can use the free services, but they don't give you all 3. So again, you want to see all 3 reports. If you have some negative items on your credit report, you want to immediately go to work and have them removed if possible. Now, to do this, I highly recommend a well-written and organized credit dispute letter. A credit dispute letter, or 609 dispute letter, or sometimes called a debt validation letter, they're all the same. It helps you professionally address inaccuracies found on your credit report and request they be validated, and if they can't be validated, request a removal from your credit report. It's been proven very effective in helping to remove erroneous tax liens, repossessions, collections, bankruptcies, derogatory accounts, or closed accounts, or charge-offs, or late payments, and even hard inquiries, and effectively, if you use it right, effectively raise your score in 45 days. I like letters for this removal process because although it may take longer, it provides a better paper trail of your efforts as you move through this process. Now, we've attached a copy of a 609 letter, or at least a link to it, for your free use. So it's a free copy. Be sure to go to our show notes below for that link and where that is. It's called a 609 letter after Section 609 of the Fair Credit Reporting Act. So where did the name 609 come from? Well, it's called a 609 letter after Section 609 of the Fair Credit Reporting Act, or FCRA, dealing with consumer disclosures that provide some basic protection to consumers against false and erroneous reporting. Well, in plain English, Section 609 places the burden directly on the credit bureau and the creditor to prove an account is actually your account. To do this, the creditor must give the credit bureau a copy of the original the creditor's documentation. That's what you filled out and signed to actually open the account. So they have to deliver that to the credit bureau to prove. Here are some helpful tips to getting the best results with your 609 letters. Use the template and follow its instructions. Dispute no more than a maximum of 20 items in one letter. Also, make sure each credit bureau gets their own individual letter addressed to them. Space the 609 dispute letters 4 to 5 days apart as you send them to each credit bureau. This can be helpful in potentially getting items removed after sending each credit bureau one letter. Mail each letter by certified mail with a return receipt requested. If you haven't heard of anything from the credit bureaus after about 30 days, you may need to basically rinse and repeat this process with each credit bureau multiple times to get items removed. Be persistent. It's your credit report. If you're still not getting the responses you need, you can contact the Better Business Bureau or the Consumer Financial Protection Bureau, or CFPB as they're known, to file an official complaint. Now, some finer tuning methods. Pay on time, keep your balance to limit ratios low. That's your credit utilization. We talked about that before. Try to keep it between 10 and 30%. If you can try to pay your credit card account to 30% or less 1 to 3 days before the statement date, which is usually the same every month, because it's the balance of that credit card or loan that gets reported to the credit bureaus. When you pay off your entire balance before the statement date, you eliminate paying interest and your credit utilization will be seen as zero by the credit bureaus. At times, it may actually take several payment cycles before the interest charges to actually clear, but they will. If saving on interest charges isn't important and you need to hold on to more cash at the time, pay the minimum, because it doesn't matter to the credit bureaus whether you're paying on the minimum or not. Paying on time is much more important to establish yourself as risk-worthy by the credit bureaus. I caution you on this though. Don't make paying the minimum a habit because it will keep you poor. Work to maintain a good credit variety of revolving and installment loans. This can actually be done in a few short months. This takes several years to attain, so this is more about being the tortoise and not the hare. Try to reduce the number of hard inquiries per year, which sometimes occurs when people get into a financial pinch and are basically living on credit. For some helpful strategies with this, be sure to watch our video, How to Pay Off Debt Super Fast, and How to Manage Your Money Properly. Understand that 70% of your credit score is derived from what you've done in the last 2 years. Don't allow any of your credit accounts to go into collection. Live and spend like you expect the worst to happen. This will help you keep your buying appetite in control. Remember, every dollar you spend on credit that you can't pay off in 30 days is like selling a part of your financial future. It's not how much you know that matters, but what you do consistently with what you know that does. Now take this information and change your financial future. And please share it with family and friends because they don't teach this in school. So if you like this video, give us a thumbs up, and obviously please subscribe. Hit the notification button to be notified of our upcoming video. We'll see you next time.